to our panel, where we're talking about credibility amongst everything. This is about the year ahead, what we look forward to. I've got with me Jörg Kell, the founder of and executive director for a long time of the UN Global Compact. Grew out of his time in the UN Secretary General's office over many years. And over the last year has been the chair of Arabesque Partners, which is an asset manager, but also an ESG data alliance aspect to it, which you'll describe just in a minute. I've got Davide Heller, who's a director and head of sustainability strategy at Citi. Citi is, by the way, our gold sponsor, but they're also a bank that's doing something. You heard from Jane Fraser earlier on. I'm sorry, other banks, but that is a damn good CEO statement that we got there. And the first speech she made when she became CEO was like jaw-dropping as far as I was concerned. So Davide has to make all that happen, of course. So that's why she's on the panel today. And then James Norman, who's the Global Head of Sustainable Strategy for Goldman Sachs Asset Management, as you just corrected me earlier, AUM of 2.3 trillion a year. So, okay, not as big as BlackRock, but pretty damn big. And a key player in a bunch of markets, such as short-term paper and the like. So this is our panel to think about the year ahead. I'm going to ask Jörg to get us going, because he's written a lot about ESG strategy, and we have this kind of rumble in the jungle going on about ESG at the moment. Your reflections on where this is going to go, always with the back of your mind, thinking about the capital flows we need to achieve to fix the mess we're in.
Well, that's quite a challenge. Let me do a very quick reflection forward. And as you know, we cannot predict the future. We are supposed to learn from the past, but even those lessons we often forget, sadly. We are in an era now which is genuinely different from the past decades. It's not only the war in Europe, which has changed basic perceptions about governance and power. It has brought on a new strategic rivalry. It has led to the accelerated disintegration of multilateralism and international collaboration, sadly. It has led to supply shocks and so forth, and has accelerated inflation. The era of easy money is over as well in macroeconomic terms. Now, this may all sound very bleak. And yes, there are a lot of real uncertainties out there and real big ticket risks, which we cannot predict, but we can somewhat prepare in terms of resilience, somewhat. And that's where we see the reshoring, we see the new strategies in place now. And there is, however, a wonderful side effect of all this. One is it acts in the medium term for sure as an accelerator for transformation away from industrial era mindsets towards future fit mindsets. And that, in my view, has long been the big theme behind the ESG trend, behind sustainability trend. And behind it is another fundamental force that is irreversible and here to stay, and that gives us really hope, and that is technology. Technology and innovation is not slowing down in times of crisis. The opposite is the case. Crisis diminishes barriers for change. It increases the appetite for risk-taking. And we see right now really systemic big picture changes happening across industries, across sectors in many different countries. We see great new innovations upcoming. And it's not just AI in its narrow sense. It covers everything from material to physics. And so technology, I believe, is accelerating, is converging, and it's pushing this agenda forward. Why? Because it facilitates and enables the ever better quantification and qualification of external factors that have a long-term impact. Add to that the general trends of awareness creation that is unstoppable because Mother Nature ultimately, as you outlined so eloquently, will force our hand one way or the other, ready or not. And then, obviously, the response, the creativity is what will count. Allow me here, just quickly, last week, I issued a book, Technology and Finance, because the disruptive nature of that is often underestimated with my two wonderful co-editors. And we try to bring these perspectives to play here. Technology as a bridge builder is key too, because the sustainability, climate change movement on the one track is often driven by advocacy. by climate scientists and by fear. But on the other hand, technology and entrepreneurship and the solutions actually speak to the opportunity side of it. And I do believe that the opportunity side of it is rapidly gaining momentum. And my firm is doing ESG data, but we are primarily a technology firm. We moved away from asset management. We have an AI platform, which I hope will revolutionize a number of things. So I firmly believe in the power of the change factor, and it is definitely accelerating. And I'm saying it's not just because I'm an engineer and I've been following trends all my life, but I also see it at the corporate level, I see it at the investment level. I'm really getting excited. We have been dreaming about circular economy in '92 in Rio de Janeiro. That's where my journey started with a big conference on environment and development. But it didn't really go very far, except for a few. Now, circular material flow is becoming a viable proposition because material prices increase, because security and supply chain vulnerabilities. So this new paradigm is really kicking in now. And if you look at CEOs and strategic decision making, they always now ask the question, will we be fit in 10 years down the road? So investment decisions increasingly are motivated. For me, ESG, sustainability, and voluntary initiatives in general are a transient change enabler, a very important one. But ultimately, market signals and prices will fully embody the risk and opportunity equation. It just takes time to find a new equilibrium, to find a new perspective, and to marry our short-term obsession and our emotional biases towards the immediate decision-making versus long-term thinking. And that change is happening as we speak, and that gives me a lot of hope, I must say. I see the most exciting initiatives happening right now that I'm retiring. It looks like I'm 20 years too late or 30 years too late. But you guys, you are the ones who can make it happen. So the framework conditions will propel it forward, no doubt. Not to mention the regulatory, as my colleagues tell me, 700 regulations in the last 7 years, all sorts of aspects of the sustainability climate agenda. This is unstoppable as well, because policymakers will always have to respond to preferences. And the preferences in society shift in an unpredictable way. It's very hard to say, yes, there are long-term trends, there are intergenerational trends, yes, but then we know human beings are lazy, phlegmatic, and so forth, like we all are. The tipping points are hard to predict, but they do exist. And these tipping points, once they happen, then the regulator, wow, they often overdo it then. They think, now we have to step in and we have to make peace again with society. So that is something to be watched at. I think the Europeans, in my view, are overdoing it, frankly. I think they're creating a hell of a transaction cost. Lawyers and accountants will be happy. But will that really change the priority setting of long-term investment decision-making? I'm not so sure. But that needs to be seen. So sorry for this kind of lengthy introduction. But I wake up as an optimist, and sometimes I go to bed as a pessimist, I must say. But at the end, we have no choice but to remain optimistic. And that's where technology, the opportunity space ahead of us, they are abundant. And framing it in that context, I believe, is the most compelling story. Why is Tesla's valuation 10 times higher than the big automotive companies who have only a tenth of their market valuation? Because investors understand the future is e-mobility. The future is vertical integrated production. The future is cell technology where you can reuse all materials 98%. It's a whole new business model. Why in other sectors is the valuation of some company? It has to do with shifts in perception about long-term opportunities. And I think that's the space to go, and that keeps me optimistic. And some more stories are in this new book.
There'll need to be some kind of free rein for others with books later on and drinks.
Sorry for that.
But thank you. And it is a very interesting book. Well, after that, I've got to go to someone who's trying to wrestle with strategy in an actual investment environment. James, you're doing sustainability strategy across this humongous portfolio. Give us your thoughts on the year ahead, on reflections of what York said, and the landscape. And I'm particularly interested in the US landscape because York has sort of skated over those sort of little, let's just call it ESG noise happening in the media and so on. I'm curious what is happening in practice in portfolio allocations and management.
Yeah, I would have to say I'm probably the opposite of Georg. I wake up a pessimistic person, and hopefully by the end of the day I'm optimistic. And that generally actually is the case. And I think a lot of us have a negativity bias. We always look at the negative side, and that's what we're focused on. We're most concerned with risk. Risk aversion certainly is very much a focus. So it's easy to be pulled into that. We all know that there is this 10-year horizon, and in 10 years we know whether if we're forecasting something. We have a sort of a positive view of where we're going to end up, but maybe in the next year, there's a lot of concerns around a lot of downside risks. So let's turn this from the negative side, and we see a lot of ESG regulation sort of concerns, a lot of states within the U.S. coming out negative, trying to come out with statements to limit engagement and investment in the space. It's very easy to get negative. But on the positive side, dealing with the client base that I deal with, which is mostly corporates who have a lot of money on their balance sheet, otherwise known as mostly technology companies, or healthcare companies where they have tremendous amounts of capital that they set aside in the U.S., which is its own dysfunction potentially, but they have a lot of money. And then dealing with our large asset owner clients, pension funds, sovereign wealth funds. And one of the things that really encourages me about the activity for the next year is that the number of conversations are still very high, very robust, and they are still moving in the positive direction space. Now, there were the true believers that are continuing to be moving on, for example, the public funds on the two coasts. But increasingly, we're seeing that the corporates who are leaning into these issues around decarbonization, where they can actually do that, they're taking the assets they have, and they're wanting to align those portfolios with net zero pathways. And they're trying to understand it. They're trying to, clarify how they're going to do that. What is the potential impact? What are robust frameworks? How do they evaluate that information? And that's across both fixed income portfolios for short duration assets on their balance sheet, but also those who have large pension plans are ones where they're really taking those assets and figuring out sort of how can I take advantage of these huge shifts that we've seen, driven by technology in some cases from sort of new startups. That's obviously been a challenging space performance-wise. But what do we do to do real economy change to identify those carbon-intensive industries? They're going to have to shift. And we've seen from Europe, the companies that have shifted where there is more advancement. Utilities is a great example. Mm-hmm. The ones in the utility space that have shifted more towards renewables have been rewarded with much higher PE multiple expansion. They're much more highly valued. So one can imagine that the same thing is going to happen in other parts of the world. And we have seen that, to a certain extent, start to happen. But there's always this lag between this forward forecast and met potential and where the valuation is now. And people are a little bit negative on it. So it's a great opportunity. And investors are seeing that. So the thing that makes me optimistic is that the client base that we talk to, for their current assets, they want to convert them to really incorporate and take advantage of these opportunities and address the risks, of course, but really the opportunity standpoint. It's turned from a risk only to an opportunity standpoint. And increasingly, those who hadn't been doing this in the past want to really lean into the topic. They want to learn more, and they're willing to allocate capital, either through taking a theme and taking it across asset classes, or doing a pilot portfolio and saying, let me experiment a little bit here. Let me try this, and if this is successful, I'm going to roll this out more broadly across the various asset classes that I feel more comfortable and sort of layer that over a multi-year time frame. The next year, I'm very bullish about.
Very bullish about. That's a great way to finish the line, isn't it? Okay, you've got me going now. Of course, it is appropriate when to start off negative and in a positive, given, well, it's exciting in a way because it means that you're looking through the specifics of portfolio management and allocation. You're actually finding opportunities, and that kind of gives me hope in this, I think. But Davide, you're working with the clients out there to try and help them transition, shift them, figure out their paths forward and so on. What's your take on this? What's your colour about this?
Well, I'm an optimist in the morning and at night. Yeah, I mean, what an interesting time. I think as we mentioned, Jane Fraser, our CEO, on her first day, she announced our net zero commitment. And over the past couple of years, um, the approach and the work that's been going on internally to truly develop our targets, first for energy and power, now we're moving on to other hard to abate sectors, but also really shifting and creating teams within the company to really be able to target this work with our clients. So we've developed a sustainability and corporate transitions team. We've moved some of our banking teams around to focus on the clean energy transition and natural resources. And I think it's just representative of a shift in the need to really engage with clients and work with them across the transition. So, what does that look like? I think in a lot of ways we're still figuring that out, in that we announced these targets, announced our plans, and now it's really working through to understand what are those questions that we really need to engage with our clients on. So, what does their transition look like? What are they reporting? Has been talked about, the idea of climate disclosures and that becoming more regulated, to kind of be able to have that apples to apples comparison, but really working with them in these different sectors. What will their fleets look like? What will their assets? How do we kind of take them through that process? And I think what we're starting to see on the corporate side is, as James mentioned, just real engagement, in the sense our clients are looking to develop their own plans as well. And then I think on the sovereign side, so in looking at governments, I think these announcements that have come out of COP, whether it be Egypt's sustainable finance framework, Israel's green finance framework, and then others that we heard coming out as far as India, Uruguay, and then seeing countries like Chile, where pretty much every issuance they have is either green, sustainable, social, etc. I think we're just seeing this galvanizing of really trying to identify those solutions on both the public and the private side.
How hard is the art of identifying in practice? I mean, there's a lot of different pressures in organisations, and like the steel industry, for example, we've been involved in responsible steel. We published, in fact, today, our transition steel criteria for certification in green bonds markets and so on.
Yeah.
But the steel industry is saying, look, that's good, but that's really hard for us. We can't make the transition because they need procurement. So I'm curious, is this...
My friend is actually the CEO of H2 Steel in Sweden, the world's biggest carbon neutral steel plant, and he is compellingly and convincingly making the argument, unless and until the carbon price is at equivalent of roughly $150 per ton, he cannot compete internationally. And that is actually one of the key dilemmas, is when voluntary and technology is ahead of markets and societies, how do you make sure the momentum actually happens? And the conventional approach is subsidies, and we know the history of subsidies. I mean, the IRA is basically a subsidy program of huge proportions. History will show how it plays out. But ultimately, and we saw a new paper being proposed by the US now, forming a carbon steel club to offset, and the Europeans are very advanced as of 26, the border adjustment tax for carbon. I think carbon will become the new equivalent of trade and investment negotiations. It's unavoidable. And carbon reduction is a currency of the future. There's no doubt it is bound to happen. When and how is an open question. So in the interim, when the price signals have not yet reacted to the risk and the opportunity equations, then you have these dilemma situations. You either carry through subsidies or through protectionism, or you have a long-term view. But it's a complicated, messy world ahead, I think. It's not easy. The same as in cement, the same as with chemicals. In the automotive industry, the shift is happening already. In energy transformation, it's happening too, thanks to technological progress in all areas. But in other critical segments like building, it is a far cry. We still have a long way to go.
Is it really that hard? I mean, I'm
It's really
curious.
that hard. It is hard, but that doesn't mean that that's not an excuse to not do. I think that, speaking about steel, we saw in September the announcement of the Sustainable Steel Principles.
Yep.
Ourselves, other banks, major companies in the industry, along with RMI, committing to exactly that, putting in the work, collaborating on really understanding what does that transition pathway look like, because it is hard. And I think to what we've been talking about, we need those solutions because they're not here yet. And so we really need to mobilize that capital towards that. But similarly, like with the Poseidon Principles, I think we're seeing the private sector really look to identify these solutions.
May I just comment? I think the solutions exist already. Most of them, we could decarbonize almost all aspects of the economy, but the pricing isn't working yet, because we still allow pollution to happen, and it's basically still free. The world still spends more money on fossil fuel subsidies than it does on total investment in renewable energy. Just keep that in perspective. We are still tied up in the old paradigm. Oh, make cheap coal, cheap oil available, and everybody's happy, as is widely believed. And that's the dilemma. It's a pricing dilemma. And I would even go a step further, and I would claim, let me one more point. Hundreds of companies, or actually over 2,000, have committed to net zero, and I hope you're not one of them. They actually would go bankrupt unless and until the framework conditions along the lines that just outlined will change. You're basically banking on the future that framework conditions will change. And that's a good assumption, I would agree. But unless and until framework conditions and pricing in particular of externalities changes, the economic viability of massive scale transformative solutions will not happen. That doesn't mean we shouldn't support it, because it helps also to prepare the ground for, it enables, and it brings down cost. But ultimately, we're talking of systems changes of a pretty big scale.
Right. I think scale is very important. We need to move more capital into this space. So how do we convince more capital to go into that space? Because if you can scale up, solar is a great example. 10 years ago, it was far more expensive. The costs have gone down by about 85% in solar. And part of that is technological enhancements, but part of that is just scale. And if you can produce at scale and sort of take that cost and the learnings that you get from that manufacturing process and sort of build that into cause the cost curve to go down, that's really helpful. Governments have to do their part. They need to incentivize, and they need to perhaps raise costs not to do the right thing. But at the same time, if we can convince investors to move the money towards those sort of investments, and we can also engage with corporates and encourage them to do the right thing. One of the reasons Tesla is valued as it is because they were the early leader. Right. They've established this lead, and they moved quickest. I think there's others like GM, arguably, who's realizing, wow, I'm really falling far behind. I better play catch up really quickly. I'm going to take my EV to ICE sort of mix to 50%, not by 2030. That's too late. I need to do it by 2025. So they just changed that commitment. So how can they then go to the market, raise more capital to be able to do the investment, to be able to do that? And that's what we need to talk to asset owners to convince them, either in both public and private markets, to take their investment portfolios, all of those assets, those long-term investors, and move in that direction. And that's where we need to convince those asset owners that is the thing that's going to pay off from them in terms of having better performance. And that's certainly our belief. But then how do we convince them so that they can mobilize that capital? They can allow us to vote those shares in that way on the proxy voting side, that we encourage us to engage with those kind of companies. But this on the fixed income side also use engagement. same thing. And especially where you own both, leveraging across that capital structure, that's actually extremely powerful. We get large investors like ourselves, BlackRock, BNPP, others, to really sort of leverage that capital structure and have those conversations. Likely, we're going to convince those companies to move in the right direction, put more of their capex towards green capex, have them disclose that information, because at least the initial research is when you do that, that usually pays off. That the valuations of those companies rise relative to those who do not invest as much in green capex.
Well, look at the valuation of NextEra versus Exxon. When it in September last year, there was a moment when NextEra's capital market valuation overtook Exxon, which I just thought was a beautifully juicy moment. Now I know it's been fluctuating since then, but the same thing happened for Ørsted and BP on the London Stock Exchange. Ørsted, both NextEra and Ørsted were coal companies many years ago. They shifted to renewable energy strategies and so on. The fossil fuel companies haven't made the transition. I agree with you on pricing, but I don't necessarily agree with you on the silver bullet solution that is suggested. External pricing in terms of carbon price would be great, but I'm also going to say, it's a bit of an elegant theory in search of practical application. There are other ways of getting the pricing, and renewable energy is the good example. We did not get cheaper renewable energy through carbon pricing. We got it through government schemes with large-scale offtake agreements that drove down production costs. To give you another example, aviation, synfuels. At the moment, where I'm being told by people like Neste and Shell Synfuels division, they get some large-scale contracts, the price point will drop dramatically. Now, the question is how large a contract.
Correct.
And one of the ways we could do this is to bring together some airlines. The competition policy in Europe is a challenge around this at the moment. Bring together some airlines of large-scale contracting subject to a price point being delivered. And you could sort of see, I think there's a path in that particular, as an example, where we could get a 60% reduction in emissions by 2030. We'll eventually move to battery and hydrogen, but that's going to take another 20 years for a variety of reasons. And so it's a volume play, it's a scale play, but it's not necessarily a scale play with an individual company. And I'm even going to say with Tesla, when you look at the background about how Tesla got there, it wasn't an individual scale play. First, there was the $1 billion they got from the California government up front. But more importantly, the work the Chinese government has done to grow battery technology and investment, which has been a government play, has driven down the overarching cost of lithium processing and all these other aspects, which has then helped Tesla achieve its targets, right?
I agree with you in principle, but in practice, I believe that the process of change and how to go to scale is really complex and very unpredictable, and in different sectors may play out differently. Sometimes it's driven by consumer demand more in certain segments, sometimes it's driven by standard-setting bodies, and sometimes the price always matters. It at least accelerates or slows down. So in my view, it's all about the price signality, and frankly, if successful, going to scale means you can offer competitive transport and more convenient transport, then you win out, and you win out over convenience, you win out over performance, you win out over the price ultimately, less repair and so forth. So I think there are many pathways there, but in the end, you need societal collaboration. You need all actors to play in. You need corporates with technology, the forward-looking ideas. You need finance who are willing to support the transformation, the transition. And you need, of course, the public policy making to not stop, but rather to support the transition. And you need people with awareness and sensitivity to go for change. It is a fundamental change to recognize that natural values increasingly appreciate over time. And we no longer live in the industrial era where we can just exploit ever more and more and take and produce and consume and throw away. This era is coming to an end. My good friend Martin Reves, the chair of the Henderson Think Tank Institute, yesterday published a wonderful piece where he argued the way to understand the new era is that scarcity is the new guiding principle. I don't quite agree, but he makes an important point. The abundance of cheap money, the last 2 decades, the abundance of cheap raw material, never ending, it all has come crashing to an end. Now we have to manage scarcity. And out of management of scarcity, we learn again how to reinvent and how to rebuild. So human progress is non-linear, it's dialectic, and therefore I'm quite optimistic that with entrepreneurship and with finance and with having the opportunity thinking long term ahead, you actually will make it. And humans will make it, I'm sure. We have, in so many societies, lived through so many traumatic experiences and always survived.
Hey, you heard it here. Humans might make it. We'll make it.
No, we'll make it.
Davide, one of the reasons I'm labouring this point a bit is that I have a hunch that this coming year is going to be the year of scale, of figuring out scale solutions, and of course through that pricing solutions. I don't think we're going to get a global carbon price. I'm not suggesting that. I think there are other ways of doing it. But nevertheless, your point about pricing is absolutely correct. Am I mad? I mean, do you get this kind of appetite?
Yeah, I mean, I think that the appetite for scale is absolutely right. I think here in the U.S., the IRA is definitely helpful and has been, and first of all, just the surprise a bit, and then just the idea of that focus on energy efficiency, renewables, transportation. I think just supporting what we're seeing in the U.S. from car companies like the GM deal and their framework. So I think that we are seeing scale, and I think, to your point, hydrogen batteries. I mean, yes, it's taking time, but I do think that there is that public-private focus on actually scaling up these solutions. So I do think that this year will be really interesting.
I mean, hydrogen's particularly interesting going back to steel at the beginning, because the key to steel, we got 96% of all blast furnaces in the US have to be rebuilt by 2030. 75% of all the blast furnaces in Europe, Japan, and China have to be rebuilt by 2030. So there's a huge capex lump coming through in the steel sector. Now, what decisions are they going to make? Are they going to? We seem to have a consensus to abandon coal. Hey, that's a win. But at the moment, they're looking at gas. And the problem of gas is methane spiking over the last 10 years. We realised actually it's not much better than coal because of the leakage factors across in the Permian Basin, in Russia, etc. So we want them to shift to DRI using green hydrogen, which is not direct reduction. I can't remember what it stands for now, but green hydrogen-based steel, like the Swedes do it. How do we get there? The cost of green hydrogen, the key factor. We had Adani, the chief of Adani recently on a panel saying that they're going to produce green hydrogen in India at 97 cents a kilo in 2026. This is moonshot territory. We've got Thierry Leperc and the Green Hydrogen Consortium in France delivering this month €1.50 a kilo hydrogen to ArcelorMittal in Asturias for the new green DRI plant. It's happening. If we can convince everyone that it's really coming through, will they make the right capex decisions? Where do you think that journey is, as an example of how scale can impact all that decision making?
Well, Australia, you forgot to mention Australia, huge investments going on.
Twiggy Forest.
Yeah, huge investments in Africa from a development angle, really delightful. Big deals are being made between European countries and Namibia, South Africa, Morocco, for whole new infrastructure outlets of a massive scale. So I don't think this is reversible. Once you embark on such big projects, there are so many moving parts. You're really starting a paradigm shift. So that's the excitement, I think, of the transformation. The key then is to see the opportunity space in it. Yeah? Yes, there are costs of adaptation, and you have to redo or redesign, but there are also opportunities for new investments and for doing things better and cheaper and more friendly to the environment. So always I would advise stay focused on the opportunity side. And yes, we have to think a bit long term, but then project it backwards to the more near-term outlook. And that's where the problem arises, because finance is short-termistic by and large. I mean, the tragedy of the horizon, as Mark put it so nicely, is a real dilemma in how to overcome it. So we have to find a way to bridge the near term with the medium and long term, either through narratives, which are compelling enough, or through short-term win-win situations. And efficiency is one of them. Other reductions of harmful things are another one.
I think that also, as far as examples, you mentioned it before, sustainable aviation fuel and seeing the energy and focus around that as a potential solution. I mean, we're seeing massive interest in looking at where that will come from, and there isn't any right now. Very, very small amounts. But I think that's also, an example of something, a technology that we're looking at, different sourcing for that. Renewable natural gas, I think, is something that we're seeing a lot of attention brought to. So I think the idea of these different technologies is where I think people are really focusing that energy in addition to the need, I think, as you say, for that kind of immediate short-term solutions.
Yeah.
So, James, apart from the focus on tech stocks and the managing of large tech companies that are cash rich, which is a wealth creation issue. I mean, we've seen the bulk of wealth creation in the US in the last 10 years being around intangible assets, not tangible assets. So it's understandable. Does this sort of conversation play across your portfolio? Is this real for you as a fund manager, or is this remaining abstract at the moment until the corporates get their act together and start coming to you? How's this going to play out?
When you say the corporates, do you mean in terms of asset pools, or you mean in terms of activities by the actual corporates?
The places you're investing, and as well as the places you're investing for.
Right. So I would say a lot of it comes from encouraging existing high emitters. Well, the first part of it was around technology, and I think there was a lot of movement towards that. So in terms of investment in clean tech and a lot of thematic funds that were sort of oriented towards that, and solutions providers. But I think over the course of the last year, as investors started to pile into that, and then we saw the performance be a little more challenged, because that was more of a growth part. So I might argue it wasn't so much an ESG lag as much as a growth impact on those assets and from a factor perspective. And I think that's caused investors to realize that they need to, sort of the silver lining or the optimistic side to that or outcome, as investors are realizing that maybe their sustainability investments were a little too growth oriented and they need to balance it with a little more value exposure. That naturally leads them to the heavier emitting industries and realizing, well, how do I differentiate between the ones, the leaders versus the laggards? Which ones have credible sort of plans in place to be able to decarbonize, and which ones that I think that's going to be recognized and rewarded from a performance standpoint. So increasingly what we're finding our clients interested in is having a more balanced portfolio towards sustainability to take advantage of this macro trend over the next 10 years. And so it's really identifying those type of companies and investing in those. So it's sort of going from bad to better, or from in more challenging areas, that those are where value is going to be unlocked. So that's where we're allocating to. Who are the companies that are you're going to see a bigger impact, and that's going to be recognized in the market over the course of the next 1, 2, and 3 years.
Transition.
Yeah.
Hey, we had that question earlier. So this is really becoming central. That's fantastic news, because of course that's how we have to change the whole of society and so on.
The narrative has changed quite a bit. Like in the past, people were concerned. I don't want to divest. That's not what I want to do. I'm not interested in that. I don't want to limit my opportunities. And I think the narrative that's around net zero and decarbonization and transition has moved away from that in a lot of investors' minds, more towards a narrative of I want real economy change. That's important. And because of that, I need to lean into areas that are maybe a little more challenging. One example, CalPERS has recently hired someone who is a low carbon and net zero investment specialist. That's a new title. I hadn't heard that title before, but that's encouraging. I think we will see more of that. Yeah. People with more traditional energy backgrounds or high emitting sector backgrounds who are really starting to be incorporated into the investment decision-making process for asset allocators. And that's where a lot of opportunities, because they realize there's opportunity there and that needs to occur. You can't just avoid those sectors. You need to help those transition. Well, how do you do that? You want to have the sort of the focus, which ones are the good ones, which are the ones you want to punish maybe a little bit more so by not investing or underweighting them, not buying their debt, not investing in their equities. And those that you do own, you want to sort of push them hard about how they're going to improve. So I think that's where we're going to see a lot more action.
We're going to need to move to round up the session, I'm afraid. I need to ask first, does anyone have a burning question they would like to put to our panel? because there was a short, brief moment where you can. 2 so far. Microphone into the front row, just behind you, Brian. No, this table first. Thank you. Because he hasn't spoken.
I think we're on. Really interesting conversation. I feel like we didn't address a couple of critical points. One is the cause as opposed to the effect. It feels like most of our investment is on kind of the lagging indicators of the issues of population growth. And how do we deal with the issues of climate, which are really driven, I think, by population. The second one is scale is an interesting issue to me as well because it limits innovation. As we focus on scale of a solution, and we start to miss some of the key innovations, which I think we've faced over the last many years, as another way to think about how we might want to try to focus on improvements and improving these problems. So just 2 thoughts.
Over here.
Very valuable insights from the session. Since we are talking about the year ahead, my question is related to the SEC climate rule, which we are waiting for. Now, in the EU, you have seen like double materiality being talked about by most of the fund managers and whatnot, right? When you go to the US and talk to the fund managers, there's a diverse views. Some of them say it's not applicable to our regime. The others say it's very material, right? Regulators, SEC people say it's not probably that much applicable. I'd like to understand, like, what's your view? And then there's a new concept of dynamic materiality by World Economic Forum. So what do you think about this concept for the US?
Good questions. I'm actually going to ask our panelists on the double materiality question. James, do you want to start off on that?
The second or the first?
The SEC rules.
SEC. Yeah, I mean, I think the U.S. really is hopefully trying to encourage more disclosure, and more data is better than less data. So I think there's a lot of resistance to that. In Europe, they are very prescriptive about the amount of information, and that is very burdensome, I think, for the organizations that need to provide that. And also it's very limiting in terms of, like, that's one of the reasons we think we saw so many markdowns from category 9 to 8 or Article 9 to 8 funds. Cost was one issue, more that as the requirements were uplifted and more clarified, people realized, maybe I am not going to be able to meet that standard quite so easily, or I might not want to. But in the US, I think really anything that can be done by the SEC to encourage disclosure is helpful. So I would say we think that that is a helpful thing in terms of leaning in that direction.
I'm just going to pick up the population question because I disagree with you. Climate change is not driven by population growth. Climate change is driven by the wealth of a small percentage of the population and the nature of their consumption. You know, if we knocked off the top 10% of the world, we wouldn't have a climate change problem for quite a long time yet, until everyone else then got us that rich. You know, it's SUVs, not bicycles, if you like, that have driven the nature of the emissions problem we face now. And you still see that in the per capita emissions around the world. It doesn't mean China's emissions aren't huge, but they've got 1.3 billion people, so slightly different. So the real issue is we have to dematerialize the nature of wealth. That's the biggest issue going forward, and also defossilize the nature of wealth, because it's been created on the back of the fossil fuel industries. So I would argue very strongly against it being a population argument, even though a reducing population will have some contribution to it. And what is the primary driver of reducing population? It's the primary education of women, to give them opportunities. So there is a job to be done there. But the first job is we've got to abandon the petrol-based SUVs and all the other paraphernalia that comes to that. That's my pitch. Am I mad, York?
No, 2 brief comments. This is a long debate we would need to have to sort that out, because there are many assumptions being made behind that. So I suggest we do this privately. We couldn't do it justice to it just by exchanging a few. There's more complexity behind it. But I want to come back quickly. I agree with if indeed the SEC were to promote more disclosure, that would be extremely beneficial. My hope actually is, and I'm a great fan of American pragmatism as such, that the focus on the most important first before doing everything else perfect is the way to go. And that's why I'm very motivated. Because if you get a handle just on carbon, and to me, the biggest policy failure of the last 30 years is the fact that we still cannot appropriately measure what really causes global warming. We still can't, despite improvements in data, yes, my own firm too, and so forth. But this is a failure, a collective failure, and it's a historical failure. So if the SEC contributes to remedy this failure, at least partly, wow. Never forget the complexities of double materiality in a dynamic context of shifting cultural changes. Leave that separate. Do what matters most first, and then move on to the next. So I'm hopeful.
David, any comments about this or any other questions you want to try and address?
Wow, great. I mean, great answers. I definitely agree on the SEC. We provided a response. I think that we want to see the climate disclosure and support that. So it might not be perfect, but
Right.
I think we can't let great be the enemy of the good.
Exactly.
Sometimes I switch those around accidentally. But I think that that's really applicable. And that doesn't mean we should ever be satisfied with where we are, but we have to move. And I think that also applies to like the data conversation. We might not have all the data. Hopefully this will help us get the data, but that doesn't mean we stop in our effort to measure. So.
Last word, James. Reflection for the audience.
Yeah, I'm extremely hopeful. I think that we're moving in the right direction. It doesn't feel that way. And sometimes when we wake up in the morning, maybe that's why I feel a little pessimistic in the morning, because you read the news and you're just like, really?
Indeed.
But that being said, I think at the end of the day, we are moving in the right direction. It's going to be a bumpy road, but from my conversations, at least with large pools of capital around the world, but even in the U.S., I think this is an inevitable march. There will be ups and downs, but it's only moving in one direction, and just have to have that long-term vision. And we're seeing a lot of companies that are small companies doing great things. We're seeing a lot of great things occur in large companies, and the seeds of that, they just need to be watered and grow. So I'm very encouraged.
So I'm going to sum this up in saying that next year is about working it out. And that's what's, I think, exciting. When I came away from the COP in Sharm el-Sheikh, where I was not in the government negotiations, I'll ignore those. I was talking industry, speaking panels. The feeling is people are now working out how to do it. So it's not a matter of what we've got to do. You haven't heard a lot today about what we've got to do. You've heard about the difficulties of getting there and what's got to be wrestled. And that's what this year, and this is necessary, right? Because if we are to get emissions down 50% globally on average by 2030, which is what our IPCC requirement is, that requires the next 18 months to be about planning, to be about developing the strategies, for Davida's clients to be wrestling at what they can do. That's what the next stage is, absolutely, while we continue to grow the market and so on, which we're going to talk about a little in the next session, a little bit. So it is going to be I really feel in my bones it's a how-to market. The conversations that the Synfuels conversation I had was with GFAN's Transition Committee, for example, and with Lufthansa's head of corporate strategy, and with the chief shareholder of Singapore Airlines. And I'm thinking 2 years ago, I couldn't have had this conversation. It wouldn't have been there, let alone the steel accidents that are happening. And of course, Sweden has now shipped its first green steel. So stuff is happening, it's getting real. There will be green finance and green bonds spun on the back of it. That'll be an indicator of change as much as anything. But what a fantastic panel, eh? Give them a clap. Whoa.